I think that the corruption that exists in the government is just ridiculous. And it's time for individuals, business owners, high-income W-2s, investors. It's time for us to become financially literate so that we can work on our own individual financial freedom. Because here's the thing, the most important freedom to fight for is financial freedom, because it leads to all of the freedoms. It leads to the freedom of healthcare, it leads to the freedom of mobility, it leads to the freedom of education, it leads to the freedom of security, it leads to the freedom of choice. Financial freedom, by far, is the most important freedom to fight for. And that's why I've been doing what I do on social media. I jump onto social media on a regular basis, and I try to elevate financial literacy. I try to talk about the things that other supposed financial gurus are putting out there for you to believe to be true regarding financial matters, regarding tax, regarding business structure, regarding asset protection, you name it. And I address it. Why? Well, I'm a lawyer. I specialize in tax, estate, and business law. But I'm also a serial entrepreneur. I own a variety of different companies, most of them in the financial space. I own a private wealth management firm. I own an accounting firm. I own a fractional CFO company. I own a tax firm. Plus, we own real estate, residential, commercial real estate. And I'm saying all of this not to be braggadocious, but to demonstrate to you that I'm academically trained in the languages of business and money, and I have actual real-world experience putting that knowledge to work in life, right? I actually do this myself. And I've been helping business owners all across the country do it for nearly 3 decades, right? So there's a lot of tenure here. And the reason I'm sharing all this the way I am is because I believe that the key to financial literacy starts with understanding the rules of the game, right? Understanding what the landscape is that we're playing in, right? So understanding the rules are critically important. And there is a significant rule change that is about to happen, right? And it has to do with something called the Big Beautiful Bill. I'm curious if you could let me know in the chat how many of you have been seeing news information regarding this bill, whether it's been on social media, whether it's been on traditional media, whether it's been at the local hangout spot with your friends talking about it. I'm just kind of curious. Let me know in the chat. Have you guys been hearing about the Big Beautiful Bill and all of the things that have been going on with it? Robin tells us the sound is not working. Can you guys hear me? Can you guys hear me? Oh, awesome. Awesome. Hopefully you guys can hear me. So let me know, have you been hearing anything with regard to the Big Beautiful Bill on social media, on traditional media, at your hangout spots? Let me know in the chat. Have you been hearing about this thing? The Big Beautiful Bill? Absolutely, Robin. Robin says, yes, everyone has a different opinion regarding it. Well, one of the things you may not know about me, I don't know if you guys have done any research into who I am and what I do, have like searched me up on social media, searched me up on through Google. If you have not, let me tell you, I am the world's foremost expert on my opinion. So I share it pretty often. And I have a lot of opinions regarding what is taking place with regard to the Big Beautiful Bill. And it really does hearken to 2 things that I personally have been adamant about. First is my distrust, dislike, disfavor, if you will, to government, right? I'm absolutely 100% an individual who stands juxtaposed to pretty much everything that government does, because I believe that most of the activity of government is really invading into our individual rights. I do understand that there are aspects of government that are critically important for society to function. I totally get that. I just don't like the corruption that exists therein. Now, I don't believe, and because I'm not naive, I don't believe I am going to be any individual that's actually going to change that reality, right? It just is what it is. And I don't think one person, at least not this person here, is going to be able to change it. What I do believe, though, is that we can create the opportunity for absolute freedom within ourselves by working and striving towards financial freedom. And that's why I position the things that I position the way I position them, because I genuinely believe that if I can help enough individuals become financially free, become amazing stewards of the wealth that they're creating, that will actually change society for the better, because if I can get enough people together that are financially free, then those individuals are not dependent upon the government in order to save them. And I believe it's possible for anyone to become financially free. Now, I recognize it's not necessarily going to be easy, but it's possible, right? Why can I say that? Well, I've become financially free. I didn't come from money. My family had to work really hard just to get up to the poverty line. Now, I'm not saying my situation was the worst that ever existed, right? There are way more people out in the world who have had way worse situations that they've had to suffer through. I totally get that. So I'm not trying to say my rock bottom was the worst of all, right? But it was mine, right? I lived through some pretty horrible times financially, and with a lack of financial awareness, that itself caused a snowball effect of challenge. But what I did recognize is that if there is a solution that others have found, well, that means it's possible. And I can reverse engineer the steps in order to get there. And part of that reverse engineering the steps is understanding the rules of the game that we're playing in. And again, there is a landscape change that is about to happen with regard to tax legislation that's important for you and I to really understand what this is going to mean for us and how we could potentially leverage it to our individual benefit so that we can individually work towards financial freedom. And then collectively, as a financial free ecosystem, right, we change the world for the better locally, right? Because that's the reality. If you can improve your locality, that over time spreads across the country. Right. And when I'm talking about improve it locally, what do I mean? Well, if you're a business owner and you're keeping more of every single dollar you make, you then get to deploy those dollars in a variety of ways. You could deploy them toward helping your own family, providing for means of support for your family, creating opportunities for others, hiring, right? Improving the end result for the clients that you serve, the customers that you serve, your local constituents, your local community. All of those things benefit as business owners improve their scenario. At least they have the opportunity to benefit. And if you're an amazing steward of the wealth, well, then that stewardship actually improves society. And that's why I do what I do. And again, the big beautiful bill is this landscape changing type of tax legislation. And the reason I say it's landscape changing is because absent that tax legislation, things would drastically change at the end of this year, because the current law that exists with regard to taxation here in the United States essentially expires on December 31st, 2025. And starting on January 1st, 2026, we revert back to what it was prior to 2018. See, that's the law that actually changed the landscape of tax last. That was called TICJA, the Tax Cuts Jobs Act. That law modified a variety of things and was really aimed at benefiting those individuals who are contributory to society, right? Individuals who are business owners, who are investors, real estate, et cetera. But that law over the past number of years has started to modify to the point where at the end of this year, it sunsets. So the president, like him or hate him, regardless of your position on it, he made certain campaign promises during the campaign. And part of that process is now him trying to realize through his party in Congress, both the House and the Senate, try to realize some of those promises in the form of legislation. Now, I personally believe that the legislation does not actually accomplish a lot of the things I would have liked it to accomplish, right? And one of the biggest contentions I personally have is that the legislation as proposed by both the House and the Senate actually adds to deficit spending over the next 10 years to the tune of about $3.8 trillion, which is a lot of money, right? And I actually was hopeful that they would try to cut spending, because I think that the spending that the government does is absolutely ridiculous, right? I just believe that in my core. But when it comes down to this environment, we have to understand, well, what's actually happening? Like, again, campaign promises were made. What does that actually mean, and how does it translate to how things happen? Well, Congress is our legislative body. Congress is the part of our government that actually creates law. And in the congressional ecosystem, there are two chambers. There's the House of Representatives and there's the Senate. And earlier this year, the House of Representatives essentially got together and they figured out how to put onto paper this embodiment, if you will, of some of the campaign promises with regard to tax legislation. So they passed a bill called the One Big Beautiful Bill. They passed this bill in the House of Representatives. And the way our government works is that bill then moves to the Senate. So the House of Representatives passed it, and then the Senate picks it up, takes a look at the version, reads through it, and then they start to debate and argue and try to figure out what they would agree to. And the Senate, at the end of last weekend, finally, because they've been debating, considering this for a while, they finally came up with their version. So they voted on their version of the One Big Beautiful Bill. But that means there are two versions. There's the House of Representatives version, and then there's the Senate version. Now, what this means is in order for a bill to potentially become law, it needs to be signed by the executive branch, the President of the United States. But the president can't sign two different versions of the same bill. So what has to happen now is, since the Senate has passed the bill, their version of the bill, it goes back to the House, where it currently is. And the House then starts discussing and trying to figure out whether or not they can vote on the Senate's version of the bill. And that's a process that has to be done, right? Because again, they have to consolidate this into one version that gets presented to the president. So yesterday, the House really debated a lot. They talked about a lot of different things. And they finally got to a point where they agreed, and then they had to issue something called a ruling. They had to vote on a rule by which they're going to accept the vote for this particular Senate version of the bill. And that's where things got stalled. Again, I'm not trying to give you guys a civics lesson, but I think it's kind of interesting to understand what's actually happening right now. The House of Representatives, all day yesterday and into the wee hours of the morning, were discussing a lot of things, and they started requesting a vote on certain rules that they would follow for the final vote on the Senate bill. So it was more of an administrative thing that had to happen. But what was interesting is there was not enough yay votes, and the House Majority Leader just kept the vote open. So when votes are happening, there's a clock on it, right? They have a clock with regard to how much time everyone has to actually cast their vote. But not enough Republicans, to the tune of about, I think it was like 13 at my last count, would not vote on it. They either voted no or they didn't vote at all. And that meant that there was not enough votes to approve this administrative thing. Not even, it wasn't about the bill itself. It was just about an administrative matter that was necessary before they could vote on the bill. There was not enough that happened. And it was stalled. So the House Majority Leader kept the voting open, even though the clock had run out. And he's allowed to do that. Like the House Majority Leader is definitely allowed to do that. And during that time, while the vote was kept open after the clock was running, I'm sure there was a lot of back and forth. Now, no one has yet reported, at least not that I've seen, what deals were made behind the scenes. But eventually, I think it was about 3:30 this morning, because I was watching this unfold live. About 3:30 this morning, the House finally was able to get enough votes to pass it. Right now, there's 535 members of the House of Representatives. They had to have a majority to say yes, that they would approve this rule. And then what happens is, after that approval, there's this thing called the magic minute, which is sort of like this this opportunity for the House Majority Leader and the House Minority Leader to say a few words, right? They're granted this special privilege to be able to talk. And again, this is more of like an acceptance thing. It's not an actual rule. It's not a requirement under the Constitution. Congress itself just says, the House of Representatives says, we're going to do this. So what happened is, usually this magic minute is only a few minutes long. Sometimes we've seen a magic minute last a couple hours. But it was interesting because the House Minority Leader, Hakeem Jeffries, just started talking. He's been talking for hours. He's still talking right now. Like normally, again, the magic minute is only a few minutes, maybe an hour. It's been 3 hours plus that he's been talking. And remember, this is only with regard to the administrative issue, the rule. It has nothing to do, meaning the vote and the issue, has nothing to do with the actual vote that has to happen to approve or disapprove of the Senate version of the bill. But that's what's happening right now. It's sort of like this concept of a filibuster, right? The House Minority Leader is just talking, and he's permitted to talk as long as he wants to, right? So this is an interesting thing that's unfolding. But here's the heart of the matter. No matter what, the House has enough votes, meaning the Republicans, to pass this bill. They have enough votes. So as soon as the theatrics are done, which again, I'm not watching it now, but I'll have my team pull up and see if they can see on C-SPAN is Hakeem Jeffries still talking. Regardless of when, as soon as he stops, they're going to move on to the vote. And there's enough votes in the House to pass the big, beautiful bill. So what does this mean for you? Well, there's a lot of things in this bill. A lot. There's things that address farmland. There's things that address healthcare. There's things that address taxations and tax rates, right? There's things that address businesses and business ownership. There's things that address investment real estate. And I'm going to talk about just a couple things that I think is important for individuals who want to work towards financial freedom, things you need to know about what's about to happen with our tax landscape. Our tax landscape. Now, here's the thing. The concept of taxation, I believe to be not theft. I think it's extortion, right? The IRS has guns. But nevertheless, it is the law of the land. So you need to learn the law of the land so that you can operate within the context of the law, but to your advantage, right? If you know the rules, you can play to win. Now, what happens a lot on social media, these financial gurus get out and they talk about are sound bites. And they sound really good until you understand that there's way more to it than a sound bite, right? In order to get outcome, you need to understand how to apply the law to your specific circumstance. Right. I talk with because we counsel and we coach and we consult with business owners all across the country, real estate investors all across the country, high income W-2 earners all across the country. We talk about aspects of how we apply law to circumstance. We talk mostly about things like tax reduction strategies that are both legal and ethical, asset protection strategies that are designed to help you safeguard the dollars that you're keeping, right? Keeping them protected from all the enemies at the gate, the creditors, the litigants, the opportunists who all want a piece of your pie. And then ultimately, how to ensure that those dollars that you've kept and protected, how to ensure that they go to the people and the causes that you care about, not to the government, right? So legacy planning. Because I believe that the real measure of winning at the game of business is not simply making more money. Winning at the game of business is creation of generational wealth. If you create generational wealth, to me, I believe you've won. Why? Because now your money has not only supported you, it now is available to provide opportunity for generations to come. And then you have a say in how that happens, right? So I talk with our protege members, our elite members, our university members all the time about how do we take the law and apply it to the situation. Well, the big, beautiful bill is essentially saying the existing landscape with regard to tax rates is going to stay the same. Remember, I said earlier that it was supposed to expire at the end of this year, 2025, December 31st, 2025. And it was going to revert back to what it was prior to 2018, which would have meant tax rates pretty much for everyone earning more than about $70,000, $75,000 a year or so. Everyone would have seen their taxes go up, right? Now, a lot, again, regardless of who you like politically, right? It's a lot of junk that's being bantered about on traditional media and even social media by both parties, right? But the reality is, if you actually look at how the tax ecosystem is, the vast majority of Americans would have seen their tax rates go up. Now, individuals who make a lot more money would have seen it hit them a little bit harder, but it would have impacted a lot of individuals. So the fact that the big beautiful bill is going to keep the existing landscape, relatively speaking, intact with regard to tax rates and tax brackets, that means that for most individuals, just in that aspect of the tax code, there's really not going to be much of a change. But there are some provisions that do improve lives for business owners and real estate investors. Let's talk about the business ownership aspect first. There's something called qualified business income, right? And there's this deduction that is now available, created under TICJA, right? The Tax Cuts Jobs Act. This ecosystem where there was an attempt to try to level the playing field between corporations and small business owners, right? Corporations and small business owners. So corporations in the United States have a flat tax that is imposed on the corporation itself. And then after that tax is paid, if profits are distributed to shareholders, those profits are then income taxed to the shareholder, right? So the corporation pays a tax, and then distribution of profits, that gets hit with an income tax as it's received by the shareholder of that corporation. A lot of people like the corporate flat tax environment because the flat tax rate is pretty darn low, 21% right now in the United States. So that means if a corporation, a C corporation, earns $100,000 of profit, they pay a tax of $21,000. It's a flat tax. It's 21% flat tax. And the remainder, $79,000, it could stay in the corporation. They could use that money in order to reinvest and to enhance the corporation. It could be distributed to the shareholder. Again, that's a decision that gets made by the owners, I should say, of the corporation. But regardless, that flat tax is pretty darn attractive, especially when compared to other corporate tax rates around the globe, right? 21% is pretty reasonable. It's not the lowest that exists, but it's definitely attractive. However, small business owners, which really comprise the majority of what actually happens in the United States, there are about 33 million small businesses in the United States right now. And that number of small businesses control nearly $14 trillion of revenue generation, right? So we're talking about a sizable sum of businesses that generate revenues, right? But there was really not a super preferential tax system for business owners prior to 2018. You dealt with, because most of those businesses, those 33 million businesses, are pass-through in nature. They essentially pass the income tax from the business to themselves, and they personally report all of that income on their personal returns in some form or fashion. But regardless, there's a disparity. Corporations have the preferential flat tax ecosystem, and small business owners have the ordinary brackets, right? The traditional brackets, all the way up to currently 37% at that top bracket level. So TICJA came about and it changed things. It gave this opportunity for small businesses to receive a deduction off of the top relative to the profits that business, that small business generates. And the deduction that TICJA put into place was a 20% deduction from profit first. So the company, again, $100,000 of income from a taxable standpoint, $100,000 of taxable income. Right off the top, $20,000 is a deduction. So it reduces the taxable income by $20,000. And that was pretty darn attractive. Now, it doesn't apply to every single business out there. There's some caveats, some businesses that are not permitted to use QBI deduction. But for the most part, this did create an environment where a lot of businesses were truly excited. They were like off the charts, like, yes, finally, the government's starting to see us as really a value to society and giving us a benefit, not just these large corporations. And again, that's pretty darn attractive, right? 20% deduction right off the top. How many people would love a 20% deduction right off the top? Let me know. Let me know in the chat. How many people would love a 20% deduction right off the top? Let me know. Let me know in the chat. How many of you would love a 20% deduction right off the chat? Yep, I see that. Yeah, a lot of you, right? A lot of you would love the opportunity to take 20% off, but how many of you would love to take 23% instead? Well, that's what the big beautiful bill is going to do. The big beautiful bill is going to take that QBI that QBI deduction from 20% and raise it up to 23%. Again, you may not say that 3 percentage points is a lot, but on $100,000, it's an extra $3,000 of deduction. And for many business owners, that could be the equivalent of $1,200 of tax savings, right? Tax savings, in the pocket savings. What would you do with an extra $1,200? Again, it doesn't sound like a lot, right? Like $1,200, right? But it's $1,200 of your own money that instead of you giving it to the IRS, you get to keep it. Who wouldn't be interested in that? I hate the IRS. I don't want them to get a single penny more than they absolutely have to. This modification under the One Big Beautiful Bill creates an opportunity for small business owners to level the playing field even more with the large corporations that exist out there. Now, don't get me wrong. I think that the large corporations also have some problems, and I think they get way too much, in my opinion. But this levels the playing field. The 33 million small businesses out there, the vast majority of them are going to have this opportunity to take advantage of an increase in the QBI deduction, which is going to put dollars back in their pocket, dollars that they can go out and use to either reinvest in their business, hire additional employees, go through the process of maybe investing in real estate, investing in other businesses, investing in themselves, right? It's your money after all. And instead of giving it to the government, you get to keep it because of this modification of tax legislation. Now, that in and of itself, I think, was a pretty significant component to the Big Beautiful Bill. And again, does anyone know, is Hakeem Jeffries still talking? Let me know. Let me know in the chat. Is he still on the floor trying to delay what I believe to be the inevitable? I'm kind of curious. Let me know in the chat if he's still talking on the floor. If you just tune into C-SPAN, let me know. Let me know in the chat. Either way, I say it's delaying the inevitable because, again, the reality is the House of Representatives has enough votes on the Republican side of the spectrum to pass the Senate version of the bill. Now, here's the reality. Let's assume for a moment that they do go to the floor to vote and it doesn't pass. Well, what that means is it's going to create something called a congressional conference, which is going to be comprised of a couple members of the House and a couple members of the Senate who have to get together and formulate the bill. Like they have to negotiate back and forth with regard to figuring out one version that would go to the president, right? So the reality is, again, I believe that there's enough votes right now in the House of Representatives to pass the Senate version of the Big Beautiful Bill. And I believe that this will play right into the media objective of the executive, where you're going to see an opportunity for the executive to essentially sign this tax legislation on July 4th. Like, think about the metrics of that. Like, that is definitely going to play right in to the politicization, if you will, of tax reality. And there's a lot of sound bites that are going to come from that opportunity, like cutting taxes and creating opportunity, right? Again, there's so much being bantered about with regard to this tax legislation that this is going to create a great opportunity for the President of the United States to sign a bill on July 4th having to do with cutting taxes. Because that's essentially what is happening in this bill. It's cutting taxes, not for everyone, but for some certain groups of people that actually are going to, I believe, be able to benefit society, right? Because if more business owners are keeping more of their money instead of sending it to the IRS, which I believe just simply creates an opportunity for the government to misspend it, that misallocation of capital, because again, the government doesn't make money, it takes money and then redistributes it. I have big problems with how it chooses to do that most of the time, right? Anyone else with me? Anyone else have that same opinion? Let me know. Let me know in the chat. Like, do you guys believe that the government misallocates our capital? Yes or no? I believe fervently it does. This is an opportunity for wise, informed business owners to take their financial life and move it in a direction that could put them on the path of generational wealth creation, right? Generational wealth creation. Mike says absolutely. Darcy, yes. Jonathan, all the time. 1000% misallocation. I agree with you, Actor. I agree. You hear me talk about that all the time. But this moves us now into an aspect of the One Big Beautiful Bill that I believe is critical for you to hear. Critical for you to hear. If your goal is generational wealth creation. I don't want to make that your goal, but if your goal is generational wealth creation, you absolutely want to hear this next part. Because the next part has to do with something called bonus depreciation. Bonus depreciation. You see, when it comes to business ownership, and don't get me wrong, real estate, when done correctly, is business. Real estate, when done correctly, is business. Bonus depreciation is this opportunity for a business to take a deduction, an expense, if you will, to reduce their taxable income based on certain capital expenditures that are made that don't necessarily create an expense in the year that they are made. What do I mean by that? Well, typically when a business spends money on things, there are two ways that those dollars are treated from a tax perspective. They are either treated as a legitimate expense or a legitimate deduction from taxable income, or they are treated as a capital expenditure, which is not a deduction. So as an example, if I go out and I buy this pen, the government essentially says that this pen doesn't really have a useful life that is very long at all, right? Maybe a year. In fact, likely they'll view this as something that has a useful life of less than a year. So they say that because of that, when I spend the dollar this year or the $10 or the $20 or whatever it is cost me to buy this pen, when I spend that this year, they're going to deem that to be an expense because the pen exists in this current year from a tax perspective, after which it has no value from a tax perspective, right? So they allow me to expense it fully, right? So if it was $10 and I bought it this year, I would get a deduction from my taxable income of $10, right? But there are certain things that a business owner can spend their money on that the useful life of the thing extends beyond a year. So the government says, well, in those circumstances, you're not actually allowed to take it as an expense. You must depreciate it over its useful life. There are different methodologies for calculating depreciation. And again, I'm not trying to make you a tax expert here. But the easiest way to think about it is what is sometimes referred to as the straight line methodology for depreciation, which simply says whatever the thing's useful life is, you get to depreciate that evenly over the useful life. So as an example, large equipment like this monitor, right? This is, I think, a couple $1,000s worth of an expense. As large equipment, this item has a useful life of more than a year, 5 years, right? So for the most part. So as a business owner, when I buy this, I do not expense it in the year I buy it. I have to take the total cost and divide that evenly over the useful life, 5 years. So if it was a $2,000 monitor, I know that I'm essentially going to divide that by 5, right? So take $400 of a deduction, every year for the next 5 years. And that is a depreciation expense, right? So that reduces my taxable income by the amount I'm permitted to depreciate in a given year. That is traditional depreciation. That's exactly what, like, depreciation is your ability to evenly distribute, or in some other way distribute, the cost of that item over time against your taxable income. So we have a couple of different ways that businesses get to deal with depreciation. And the first way is something called a Section 179 deduction. Section 179 deduction. Under the current law, it's about, there's a cap on it. The maximum amount of dollars you can deduct in a given year is about $1,250,000, I believe it is, or $1,230,000, I think the number is. Regardless, it's a lot of money. It's in that 7-figure range. And that has to do with equipment, certain equipment that a business would buy, right? So let's say I bought a commercial HVAC system, right? Very large, and it cost me a few $100,000. I have the potential of being able to accelerate through a Section 179 deduction the entirety of the depreciation up to the first year cap of that thing I purchased. So instead of spreading it out over multiple years, I potentially have the ability to bring it into year one. That's a Section 179 deduction. And it applies to equipment. 179 deduction applies to equipment. And what that does is it gives the business owner the ability to essentially take a big deduction in the year that they buy it instead of spreading it out over time. Right? That's Section 179 deduction. Now, there are certain items of equipment that have special rules that a business owner has to deal with. The one that most people are aware of is automobiles, vehicles, right? Vehicle equipment. It's pretty hard pressed if you spend any time on social media, especially towards the end of the year, not hearing some supposed financial guru jumping on social media to say, oh, go buy a G-Wagon and use Section 179 to deduct it. Well, if they say that phrase, just know that that person doesn't know the law. If they tell you to use Section 179 to depreciate your G-Wagon, they don't know the law, because there are caps on vehicles to the tune of about $30,000 in year one under Section 179. So 179 does not give you the ability to deduct your G-Wagon. It gives you the ability to deduct a portion of the G-Wagon, right? You actually have to use another code section, right? You have to use another section under the tax code, and that's called bonus depreciation. The first thing that applies against equipment is Section 179. Then, for any amounts over the cap that particular depreciation section has for that item that is being purchased, anything above that, you have to use bonus depreciation. And what's interesting is the way bonus depreciation was working under TICJA, the Tax Cuts and Jobs Act, it was declining, meaning the maximum amount of bonus depreciation you could take was capped at a certain percentage depending on the year. And that percentage has started to drop by 20 percentage points every year. And currently in 2025, that cap is 40% of whatever the depreciable amount is. So again, let's make an assumption. Let's say, and again, these numbers are not exact, right? Because I'm not going to pencil them out for you. But let's say for the moment that you're buying a $100,000 G-Wagon. And let's hypothetically, let's just use the scenario of $30,000 as the cap. I believe it's $35,000 or so under 179, but let's assume that it's just 30. That would mean that $70,000 could not be depreciated under Section 179, and then you'd have to use bonus depreciation in order to get additional depreciation in year one. Again, I know this is complicated. I totally get it. But the reality is, under the current law, that ecosystem is capped at 40%. So of that 70,000, you wouldn't be able to deduct all of it. You'd only get 40% of that number, right? So another $28,000 of deduction. So you would not get everything. This is why when you're listening to people on social media, you have to be cautious because they may not have a clue as to what they're talking about. They may have heard a soundbite that sounds really good, but they have no idea how it really works, right? But that's how it works, right? I'm a lawyer. I specialize in tax, estate, and business law. And I've been helping business owners across the country figure out the rules of the game so they can win. And this is important to know because the one big beautiful bill is changing bonus depreciation. It's taking that cap, that 40% cap that exists in 2025, and bumping it all the way up to 100%, at least through 2030. So from 2025 to 2030, for equipment put into service post January 19th, 2025, so January 20th forward, equipment put into service, you'll have the ability to take 100% bonus depreciation. This is huge, guys, huge. Because you get a major deduction in year one, and you don't necessarily have to pull cash out of your pocket to buy the thing, right? You could buy an HVAC system on credit. You could borrow. You could get into financing terms with the seller of the thing. So maybe you come out of pocket $20,000 to buy the $100,000 of equipment. You get to take a $100,000 deduction. It only cost you $20,000 out of pocket. This is why this is so powerful for business owners. You get to major deduction for minor cost, right? Major deduction for minor cost. This is powerful. And business owners who understand the rules can start to play the game to win. But bonus depreciation does not exist just for equipment. It also exists for real estate that has a business purpose, right? Real estate that is investment real estate, whether we're talking about residential real estate, commercial real estate, industrial real estate, right? Anything that has an improvement upon the land has the capability of creating major deductions for you. Major deductions for you. Now, what does this look like? Well, let's assume for the moment that you want to jump into investment real estate. Let's assume for the moment that you want to do that. And let's assume for the moment that you're either a business owner currently or a high income W-2 earner, and you have some capital that you want to put to work now and finally jump into the investment real estate ecosystem. Let's assume for a moment, I'm gonna map out a very quick analogy, like a sample, right? Almost like a case story, if you will. Let's assume that you want to go out and you want to buy whoa, that's a little bit too big. You want to buy a $1,200,000 property. Again, I'm using this number simply to make the math simple. You could add zeros to this. You could take zeros away from it. I just want to illustrate the math behind this. Let's assume, again, you'd have to run an actual analysis to figure this out, but let's assume that $300,000 of this amount is land. Well, land is never depreciable. Never depreciable. You can't depreciate land. But the improvement upon land, $900,000 improvement upon the land, this is depreciable. $900,000. Now, bonus depreciation when it comes to real estate has other rules, right? There's certain rules that you have to be aware of. Bonus depreciation against equipment, you have essentially the cost of the equipment, right? When it comes to real estate, it only applies, bonus depreciation only applies to stuff that has a less than 20-year useful life, right? So when you think of real estate, there's a lot of different components that go into a real estate asset, right? You have your doors, you have your floors, you have your cabinets, you have your fixtures, you have your windows, right? All of those separate things have a different useful life. But a lot of those things have a useful life that is less than 20 years. Now, I'm going to share with you a rule of thumb. Would you guys like to learn a rule of thumb? Would you guys like to learn a rule of thumb? When you're looking at real estate that is traditionally residential, whether we're talking about a single family home, a multifamily home, up to 4 units, so a quadplex, a triplex, or a duplex, right? On average, about 1/3 of the total improved value, about 1/3 of it is comprised of assets that have a less than 20-year useful life. So in the context of this scenario, that would leave $300,000 of less than 20-year property. Under the One Big Beautiful Bill, this entire amount is deductible. This could be used to reduce your taxable income. Save you guys significant dollars, a $300,000 deduction in the year you put this into service. And if you own multiple properties, right? Multiple properties. Jonathan says, I currently have an investment property with 3 apartments. Would I have to create an LLC in order to qualify for these deductions? No. The deduction doesn't require a business entity around it, although I would encourage you to do that, right? Because if you're having investment property, why take on the personal liability? Having the right structures in place from an asset protection perspective, Jonathan, that is the approach to take, right? Because not only do you want to keep more of every dollar you make, you want to protect those dollars from creditors, litigants, and opportunists, right? So I would strongly encourage you to have the right business structure from an asset protection standpoint in place. I teach our ecosystem something called the Real Wealth Matrix. In fact, I think we're having a presentation on the Real Wealth Matrix on Tuesday of next week. Is that right, guys? Let me know in the chat, my team. I think next Tuesday we have a full presentation on the Real Wealth Matrix and how we use it to save people money. Jason says yes, we do. If you guys, I don't know, is Jose in the event today? If he is, have him see if he could drop a link to that event. Like if you guys are interested, that event, I'm going to be teaching how we actually use strategies just like this to reduce taxes. We save hundreds of thousands of dollars in tax for the clients that we serve. But again, coming down to this, how do we take advantage of this? Well, this is a deduction against incomes. But here's the thing. Here's the caveat. There's something called the passive activity loss rules, right? These PALS rules, passive activity loss rules, stipulate, and this is since 1986, guys. So this particular rule has been around for a long time, since 1986. Passive income, let me say this, passive losses, they can only be used to offset passive income. Right? So if you have a passive loss, and real estate that is for investment purposes is by default passive, right? No matter what, if you have an investment property, whether you're renting out a room in your house, whether you're renting out the entire house, whether you're renting out a commercial building to an office, right? Like, doesn't matter. Real estate by default is considered passive when it is used to generate income, right? So if you have rental income. So the passive activity loss rules, they basically stipulate that losses can only be used to offset income that is passive. But there are exceptions. There are 3 of them, right? 3 exceptions to the passive activity loss rules. The first is that if you earn less than $150,000, you have up to up to $25,000 of passive losses that could be used to offset your W-2 income. It could be used to offset your income with regard to businesses that you own, right? If you make less than $150,000 of modified adjusted gross income. Now, it starts to phase out at $100,000, and by $150,000, there's no more, right? And it's essentially $2 for every dollar, right, above, or a dollar for every $2 above. That's the way it works. So by $150,000, you can't use exception number 1, right? Exception number 2 is what is referred to as the real estate professional status, REPS, real estate professional status. Anyone ever hear of REPS? 150 of AGI, modified adjusted gross income. Yes. Quell 0401, that's correct. Once you hit $150,000 of MAG, modified adjusted gross income, right? Once you hit $150,000, you can't qualify for exception 1, right? Can't qualify for exception 1. Exception 2 is real estate professional status. This is a multi-part test. You have to meet the qualifications of every part. Part A is a time test. You have to spend 750 hours per year engaged materially in the trade and or business of real estate. And there are 11 different types of things that the IRS looks to. We actually teach our members exactly how to do this. But 750 hours in the trade or business of real estate. B, it must be the majority of what you do. Majority of what you do. Gotta love my handwriting, guys. Gotta love, like, how many of you guys got on today's live and like, man, Edward cannot write for anything. Like, I definitely failed art and I definitely failed penmanship, but I know a thing or two about taxes. I know a thing or two about creating generational wealth. REPS requires you to have 750 hours engaged in the active trade and or business of real estate. There are 11 different criteria that go into that, but it also must be the majority of what you do, which means if you are a W-2 employee or you have a business that you're engaging in regularly, it is highly improbable that you'll qualify for the REPS exception. Enter exception number 3. This is the short-term rental loophole, the short-term rental loophole. This is also a multi-part test. Part A is a time test as well, but it's only 100 hours engaged in the active trade and or business of real estate. And no one else can work more than you in this business, which means if you had a third-party property manager, that wouldn't work because it's pretty hard to say that you worked longer or more time than the actual property manager did. And C, the average stay of a tenant is 7 days or less. 7 days or less. Hence, short-term rental, right? Airbnb, VBRO, home away. But when you qualify for this, you get this opportunity to pull those passive losses from depreciation, specifically bonus depreciation, and apply it against all of your other income. Massively saving taxes. So in the short-term rental exception call, yes, this is owner managed. In the REPS environment, you don't have to be managing the entirety of the property yourself. You just need to be sure that you in REPS, you are not working more in something else. So if you were working 40 hours somewhere else, you'd have to work essentially like 40 plus hours in real estate. That's just not probable, right? It's just not probable. But here's the thing. A spouse who isn't working can qualify for you, right? If you have a spouse that doesn't work, your spouse can qualify for REPS and it applies to the entire return, right? If you're married filing jointly. So you have this capability of capturing major deductions under this rule. This is one of the reasons why I wanted to jump in here today, right? The Big Beautiful Bill is a pretty phenomenal thing when it comes to giving you a guide path toward the creation of generational wealth. And I say that because real estate is a wealth creation tool. Real estate is a wealth creation tool. And I say that fervently. And this is going to sound very strange for someone, because one of the companies I own is a private wealth management firm. But hear me clear. You guys ready? You guys ready to hear the truth? Do you want to know something that is absolutely 100% true when it comes to investing? You guys want to know something that's absolutely true when it comes to investing? Let me know in the chat. Let me know in the chat. Do you want to hear something that is true when it comes to investing? Well, here it is. Here it is. It is nearly impossible to become wealthy through traditional investing. It is, let me say that again, because this is a writer-downer. It is nearly impossible to become wealthy through traditional investing. Traditional investing is great for accumulating wealth, preserving wealth, like working toward, but it's not a wealth creation tool. At least not for the vast majority of people who engage in traditional investing, right? Real estate, on the other hand, is a wealth creation tool. Business ownership is a wealth creation tool. So this gives us the ability to take advantage of tax law that can put you on a path for generational wealth creation. That's why I wanted to jump in here today, because so many people are getting so caught up in the politics of what's happening right now in Congress that they are not seeing through to understand how they can start to take advantage of a major shift in tax law. Major shift in tax law. You have the ability to potentially take advantage and let the government become sort of like this partner helping you to subsidize the acquisition of real estate because of the deductions that are now possible. 100% bonus depreciation in the scenario that I laid out. In the scenario I laid out gives us the ability to potentially create $300,000 of a tax deduction, right? And now you have an asset that cash flows. And you still have other deductions, right? Because you still have $600,000 in this scenario. You still have $600,000 of ongoing depreciation that happens in year 2 and 3 and 4 and 5, right? Now, it's not all up front in those years. It's spread out over time, but it's spread out over the useful life of the items that are still outstanding. You have major tax benefits by engaging in understanding first the rules of the game and then playing that game to win. Playing that game to win. Guys, I hope you found this helpful, right? Because again, this is I think our very first YouTube live. It's our very first YouTube live. And I jumped on here because again, there's a lot of misinformation that's going around with regard to this bill. Anyone know if Hakeem Jeffries is still talking? Let me know in the chat. Is he still on the floor? I'm kind of curious. Is Hakeem Jeffries still talking? I don't. Let me see if I can pull it up. Let me see if Hakeem is still talking. Let's see. It looks like he may be. He is. Hakeem Jeffries is still talking. He's still in his magic minute that is now, 5 hours in? 6 hours in? Because it started around a little after 3:30 in the morning. Yeah, he's still talking. Now remember, what he is blocking at the moment is not the vote on the actual bill, right? He's blocking a vote or the movement on the rule to consider the bill. Right? So it's an administrative thing that he's creating a roadblock to. An administrative thing. So the question is, will they be able to watch? I have no idea. That's for my team. This is our very first time doing YouTube Live, so I don't know. I'm certain that the team has some idea in mind for it, but I hope you got some value from this. Guys, I hate the government, but I love America. And if I can help enough Americans go out there and become financially free, that is how we change the world. And freedom from a financial perspective starts with knowing the rules of the game you're playing. Because let me tell you this, the vast majority of people out here are playing Twister while the wealthy are playing chess. And if you are playing the wrong game, you will most certainly lose. And even if you're playing the right game with the wrong set of rules, how could you ever hope to win? I want you to win. I want you to learn the rules. If this has been helpful, make sure that you follow this channel. We're trying to build this channel up so we can bring financial literacy to business owners, to high-income W-2 employees, to investors all across the country who want to take a step in the direction of generational wealth creation. So make sure that you follow if you have not done so already. If this has been valuable, make sure you let me know. I can't wait to have an opportunity to share more with you. So until then, I wish you well in your journey. Bye for now.